Hello, everyone. Michael Reese here, and this is our halftime report. So the purpose of this video is to, reflect back, see how the first half of the year has gone. I'm recording this in early July, so we're going to look back, take a look. How have the markets done year to date, say through June 30th. Also, we want to talk a little bit about what we might expect to see out there in the coming months, both in the markets and maybe also a little bit in the tax code and things that they might be talking about in Washington, D.C. that might play a role in both your planning and in what happens in the markets. So I think what we'll do is I'll share my screen and we'll start by reflecting back and seeing how the first part of the year has gone. So I'm gonna hit, let's see, share screen. Let's get the right one. And there we go. Right now, you should be looking at the Vanguard benchmarks. And as you can tell, it comes from Vanguard. These are just a number of benchmarks. Vanguard tracks about 1 million of these things. But I thought that this section really tells a story that we want to pay some attention to. So if you take a look here, we've got S&P 500. So this right here, the S&P 500 index, that is kind of the big market. That's 85% of the stock market. Year to date, it's done about 15%. So wow, just killing it. It's on track to do, if you double that, because we're halfway through the year, 30%, that would be awesome. I don't think there's a chance in the world it's going to do that. But anyway, that's where we are so far. What about smaller companies? Well, we go down here, the small cap index has done even better, 23.5%. Well, that's pretty amazing. Well, what about like bonds? Where are our bonds? Let's see, I think I might have to go up to get to the bonds here. Let's see, I'm looking for the aggregate bonds. And let's see, here we go. Aggregate bond right here, Bloomberg aggregate, minus 1.67 year to date. So isn't that interesting? The market's up, but the bond market is actually down a little bit. Now, it's not down much, 2%. I mean, not a big deal, but that's a reflection of interest rates. When interest rates rise, that's definitely creates pressure on bond values. So that's important to see. And then here we go. This one right here, what about international markets right there, about 9.4. So, what's going on here, of course, and let me just go ahead and kill this for the minute. What's going on here is that we're coming out of the pandemic, of course. I mean, this. I'm like, everywhere you look, people are getting out more and more. I think we're seeing that the airlines people are flying all over the place. And there are help wanted signs everywhere. It's like, come on, you can get rid of the extra money for the for unemployed now, because obviously people are trying to hire. Let's get these people out there so that all these companies, the restaurants, the hotels, pretty much everywhere I look, people are looking to hire. I'm sure the same is true for you. The economy seems to be growing out of the pandemic, and that's good, right? And these returns seem to reflect what's happening there. Now, with that being said, there's a couple of things going on here that indicate some trouble perhaps coming up on the horizon. So let's share my screen again so I can show you what I'm referencing. If you look back at the S&P 5, I've got to scroll down here. Here we go. What do we say? The S&P year to date, 15.25, right there, that number right there. But notice, look at growth, 14%, value 16. So what does that tell us? That for a long time, growth has been driving returns in the markets. Value is starting to outperform. What about small cap? Remember down here, small cap, 23%. Look at this, small cap value 30, small cap growth only 16. So small cap value outpacing growth by a factor of 2. And this is where it usually starts, is in the small cap before it goes into the larger. What about mid cap? The mid cap index has done 17. Value 22, growth 12. So all throughout the US market, what we're seeing is value-based companies are starting to outperform. That often occurs right before markets start collapsing before they crash. Now, it's not a sure signal, but it's definitely a red flag. And this kind of brings us into looking as, out into the future. Oh, wait a minute, before I forget, one last thing. By the way, the stock market, horrible index. I mean, this is horrible stuff to look at when you think about your financial planning, because it really doesn't matter what the market does. What matters is, are you doing okay with your personal benchmarks? But here's something at the very top. I mean, look at all these indexes Vanguard tracks. It's crazy. But at the very top, they track a balanced index. They say a balanced portfolio, it's up about 8% year to date. So on, maybe that would represent a portfolio that isn't hedged for downside risk. But anyway, just gives you some numbers as to year to date. I want to transition, though, to talk about what we see coming up for the rest of the year. So we got a couple things going on. So we just looked at how value is starting to outperform growth, which is great if you're a value investor, but generally speaking, not the greatest signal for markets overall. Well, here's the other thing that we look at, and I've shown you this before. This is the Buffett indicator, named after Warren Buffett. Now, what this does is it compares how the stock market is doing, the value of the stock market to the economy. So we've got the value of the markets up here compared to, how much the economy is producing. And the idea is this: when the market is really high, now this goes all the way back to 1950. So we're talking 70 years here. That's a long time. So we go back to 1950, when this is very high, that shows, like, usually what happens when it's really high is that the markets go south afterwards, and that's exactly what happened in the 70s. And then we see here, look at this, it came way down here in the 80s, and normally that is an indicator that when it's way down here, everybody sold, the market's priced really low, now markets are going to grow. And sure enough, in the 80s and 90s, they took off. What happened then in 2000? This thing peaked. It peaked above this red dotted line. That's measured at 2 standard deviations, not super significant. It only means that 95% of the time, or 95 in 100 years, 95 years, it should be below this number, so to speak, just like down here as well. But generally speaking, what they're saying is, hey, look at this. Look how high it got. And we all know what happened at that point. From that point on, for the next 10 years, the markets actually lost money. The S&P 500 lost money over a 10-year period. So if you bought and held for 10 years, you lost about 10%, about 1% a year. And bang, that crashed early 2000s. It started going again, the real estate market crashed, the financial crisis. And then here we are, March of 2009, boom, since then, huge bull market run since then. So today, look where we are. We are at a point that is higher than it's ever been, at least in this measuring period over the last 70 years. What does this mean? Markets are wildly overvalued. It's that simple. I've been talking about this since back at the beginning of 2020, before the pandemic hit. We're talking about how markets are overvalued. Today, they're much higher today. Even if they were overvalued back here, they were definitely overvalued today. Now, what does this mean? Markets are short-term. They react based on emotions. Long-term, they react on fundamentals. So in the short run, I have no idea where this is going. This may go higher, right? It may go higher in the short run. Long-term, however, fundamentally, it cannot stay up here. It's going to come down to the median. It's just got to come down, and it will. And when it does, we could be looking at this point, you could see a market crash of 50, 60%. Wouldn't surprise me at all. What's interesting right now, you've got value turning into favor. That's a red flag. This, screaming red flags. If you look at relative strength, which is a measure of, what is the mass of people doing? Right now, QQQs, the NASDAQ, the S&P, wildly overbought. We're in a position where a lot of our algorithms right now actually have got us moving out of the market because the algorithms are saying it's like this. On spring break, here, let me stop this share for a minute. On spring break, I took the family, Becky and I took our 3 daughters and their friends. So basically, if you do the math, that was me and 7 women. Anyway, they were nice. They let me go golfing a couple times. Anyway, we went down to Florida to Perdido Key. It's right near the Florida-Alabama border. And the last couple days we were there, it was really windy outside, like really windy. And they had on the beach all these red flags. And what that meant was they said, look, it is dangerous to swim in the, I guess that's the Gulf of Mexico there. It's dangerous to go in the water because the riptides or they're dangerous because the waves were crashing in, and they're saying, look, this is just too dangerous to swim in. Now, you would have fun swimming in those big waves, but you could also die because they could pull you out to sea and you drown, basically, right? Red flag means danger, Will Robinson, don't go there. Well, right now in the markets, it's kind of like that. It's like you can have fun in the stock market. Hopefully you'll make some money, but there's a huge risk that the riptide's really bad and they'll pull you out to the ocean and you drown. In other words, many of the algorithms right now are screaming, get out of the market. You've got Warren Buffett saying, holy cow, this is wildly overvalued. You've got the value coming in favor, which is another signal things are overvalued. At some point, this market's going to go the other direction. We just don't know when. All I know is it seems to be getting close from everything we can tell. Now, hey, I've got a crystal ball. If you've been in my office, you know that. I've got a crystal ball. It doesn't work. I might be wrong. Maybe the rest of the year ends up being great for the markets. I'm just saying right now, things are looking a little scary. Last item, taxes. As you know, they're talking about changing the tax code in Washington, but no worries. They're only going to tax the rich. So I'm sure you're fine. No, not so fine. They're talking about doing a lot of things in Washington. They're talking about raising capital gains taxes. They're talking about eliminating Internal Revenue Code 1031. They want to get rid of 1031 exchanges. They want to, which by the way, it hurts me to say this, but that is a bit of a tax loophole that doesn't make a lot of sense. But anyway, they want to increase, they'd love to eliminate the Trump tax cut and just go back to the old system. They want to get rid of step up a basis of death. There's a lot of things they're talking about. And here's the kicker. They also want to make all of it retroactive back to like April or May or something like that. Well, here's what I can tell you. Politicians, I've been doing this a long time. Politicians love to talk. I mean, they love to talk. They love to talk. They don't do a whole lot, generally speaking. In fact, I think half of Trump's problem was he actually did stuff. But, well, that and the fact that he couldn't stay off Twitter. But anyway, politicians, they'd rather talk and they'd love to talk and do nothing. That's their ideal position. But with that being said, I do think that they're going to want to adjust the tax code in some way, shape, or form. We just don't know what they're going to end up doing. I will tell you this, the longer we go in the year, the less likely it is that anything's going to be retroactive. And at this point, we already know that nothing's going to happen till this fall at the soonest. So if it turns out it's this fall before they do anything, the odds of anything being retroactive go from slim to none. I mean, let's be honest, almost certainly at this stage, any changes they make are almost certain to occur starting January 1 of next year versus this year. But we don't know that yet. right? We don't know that yet. For those of you that are clients, you know, as we've been doing tax planning, we've been kind of putting together some thoughts about what you might do this year. But we said, hey, for the most part, let's wait and see until we get to the end of the year, so we have more clarity. Any changes that they make in the tax code, and especially if they get away with some things they want to do, that could really hurt the stock market. Changes in the tax code, when you increase taxes, oftentimes that hurts the market. When you reduce taxes, it helps the market. Right now, as overpriced as the market is, it only takes, how it is that one straw, right? That tipping point straw that breaks the camel's back. If changes in the tax code might be that straw, who knows? I don't know. I just know that it's something that we worry about a bit. We're keeping our eyes on it. That's something it's pretty worrisome. But in any event, so far year to date, things are going well. The market started the year overpriced. It's now even more overpriced. Fundamentally, there's no reason that it's where it's priced right now. Right now, really, the reason it's there is it's like Tina, there's no alternative. Like, if it's not the market, where are you going to put your money, right? In any event, good start to the year. I think the rest of the year will be a lot more turbulent, keeping our eyes on it. Of course, if you have any questions, you're always welcome to reach out. So there you go. That kind of gives you an idea of where we are, where we think we're going, and just keep a close eye. We're keeping a close eye on these markets because they are truly at a point that could be, we may look back in time, several years from now, look back and say, oh my gosh, I mean, how did we miss how overvalued that was? I mean, obviously things were about to crash. I don't know. We'll see. Hindsight's always easier than looking into the future, isn't it? All right. I hope y'all have a great rest of your summer here, and we'll talk to y'all again soon.